Hey guys, I want to talk about this phenomenon called the market sell-off because I know we've experienced this over the last week or so. And last year on this date, March 9th, 2020, we were talking about a sell-off, right? And that was because of the COVID-19 thing. A lot of stocks were selling for $3 and $4 a share. A lot of those stocks now $100 and $200 a share. I can go through a whole list of them. You'd have been very rich if you were not afraid to go out there and get on the markets. So I did a video sitting at my table talking about that for you guys before. Now I'm going to do another video in a different format, hoping to get the point through. Market sell-off, okay? If you like this is part of the continuous learning library, which is available at reserve.sidemorinvestments.com. It's a group of videos that are out there giving me the ability to talk about a lot of different things and not be confined to what the content of a classroom is, okay? Because you guys know the market is huge and there are a lot of different things to learn. All right, a market sell-off is happening. That's the title here. A sell-off occurs when a large volume of securities are sold in a short period of time, causing the price of the security to fall in rapid succession. As more shares are offered than buyers are willing to accept, the decline in the price may accelerate as the market psychology turns pessimistic. Now, what does all that mean? That means this, guys. Let me give you an example of physically what happens, all right? On a market during a rapid sell-off that's occurring across the entire market. If you guys recall, in my part one course, we talk about, I think the third point on the slide about selling stocks, we say we do not sell when there is something impacting the entire market. That's from the foundations course, but let me take it further than that. Now, if you are investing in a stock, okay, and you've properly budgeted and we did all that stuff, we know we got money working on the markets, okay? And that money is sitting in that stock. Let's say that stock is sitting at $6 a share, drops down to $2 a share, right? All of a sudden, you're starting to question the process. You're questioning whether or not it was a good stock. It was, what am I doing here? What's happening? Why is my portfolio not as good as it was the day before? Now, if this is occurring, like we talk about in part one, across the entire market, why would you believe that the decision you made about that stock is an invalid decision? We can't say that just because our stock price has gone down. I talk about also in an advanced course that I mentioned before about sector rotation. I don't really do the advanced course in the live seminars anymore. I do the analysis course instead, but the advanced course is available at the website, SellOff. But in that course, I talk about sector rotation. What happened in this situation here, we saw that investors recognized the bond yield was returning a greater investment, and some investors were flocking to bonds and coming out of stocks. Well, when they do that, they're going to rotate out of more speculative names and get into more brand name stocks and also invest in bonds, okay? That's okay. That's part of a natural phenomenon that happens from time to time, okay? That's okay. Now listen, this is what they're not doing. This is why I want to make this video. They are not selling stocks in a mass quantity, taking the profit and putting the money in their pockets and going to buy trinkets and fun stuff, taking it out of the markets, and as shareholders go out and go shopping, take trips and all this kind of stuff. Remember, this money is put over there for them to work on their behalf until they reach some sort of goal. Some people's retirement, some people have 3, 5, 10-year goals. So they're not pulling that money out to go shopping with it. Now, if they were, that means that's a big deal. That means that the money's gone, it's never coming back. That means that stock that's gone down to $2 may not come back for a while, okay? But because that money is still working, when they sell that stock, it goes into a liquid form, a cash form, that what they call sitting on the sideline. Okay, that's a technical term on the market, on the sidelines. What are they going to do with that money on the sidelines? Well, they're going to have re-entry points back into those same stocks. It's going to push those same good brand names back up, right? If you're in a good stock originally, they're going to push that stock up. So what do I encourage? What I was talking about in our private group, buy more of these stocks. If you think it's good, you shouldn't get in it unless you think it's good. If it's down to $2 a share, buy more, right? So if, let's say a stock has gone from $6 to $2, right? Let's say you had 100 shares and you spent $600 on it, right? For 100 shares. Let's say it goes down to $2 a share. Now your portfolio says $200. You say, oh man, it was 600, now it's $2. Well, if it's $2 a share, if you spend another $600 on it at $2 a share, well, you got an additional 300 shares, okay? So 300 plus the 100 you've had, now you have 400 shares, okay? Now, all the stock price has to do is go back up to $6 a share. And what do you have? $2,400. And you've invested $1,200 at that point, okay? You had the original 600 for $6 a share, which is 600. You bought another, you spent another $100 with the price at $2 a share. Now you have, 200 shares, and all it has to do is to go back to the original spot, not even go higher than what it was. You got 200 shares, it goes back. Now you're at $2,400, guys. And the stock is just sitting on $6 a share, the same price it was 3 days ago. Now all of a sudden you're at $2,400. That's how you grow money. That's what they call dollar cost averaging. That's what you want to do. Get into that mindset instead of the flight mindset, running away from the markets. Hey, I don't want to do this anymore. Let me go out here and just spend my money on this other stuff. Remember, when you put money in the markets, that's money you've allocated to help you with a long-term goal or long-term strategy, okay? So hopefully that makes sense. This will be part of the continuous library, and you're welcome to see this video again and many videos like this. But that's the sell-off, okay? When they sell off, guys, that money is going to the sidelines to be put back to work in the future. So yeah, it's not sexy, it's not glamorous to go out there and look at your portfolio, it's down. But if you make strategic moves, like I just said here, by buying more shares at that price for good stocks, you're gonna be well suited to be, you'll be well positioned to be successful towards the long-term goal. Just imagine 3 years from today, you won't even remember this weekend, right? This 2-week stretch, you won't remember that. 5 years from today, all you're gonna see is that number growing exponentially, and that's what's gonna be important. Thank you, guys.